Statement of cash flows. The statement of cash flows provides managers and external readers of the financial statements with information to determine what caused cash to increase or decrease. So previous to this time, we have learned a lot about the income statement, which is used for external readers of the financial statements. We've prepared a statement of retained earnings or a statement of owner's equity, also used to prepare information for external readers of the financial statements, and the balance sheet does the same as well. This is the fourth and final financial statement that is prepared by a company each month. It's called the Statement of Cash Flows. It's a relatively new financial statement that did not really come into its own until 1987. Prior to this time, even though companies would report a profit and be profitable, there was also a determination that they couldn't figure out why companies didn't have a cash flow. And this analysis helped people understand why, where was the cash parked, and why did profitable companies not have cash to expand and or to meet certain emergencies. Cash is important to any healthy business, and demonstrates an ability for the company to meet obligations, expand, and invest. There are three sections to the statement of cash flows. The operating section, which is cash from or used by the company's business. So this is everything that came from the company operating its business. Additionally, there's an investing section. This is cash from or used by the company's investments in long-term assets, and that's going to be our focus for this semester. We're not going to be looking at investments in long-term equity, debt, stocks, or bonds of other companies, although that can be used, and that's the way a company can invest its extra cash and earn extra money. Primarily what we're going to be looking at in a basic principles class will be long-term assets. The third section is the financing section. This is where a company can finance its operations. Primarily, we hope for expansion from borrowing money from a lender, from a bank or from another company, or by issuing shares of stock in order to raise capital. So this would be cash from or used by borrowing or from issuing shares of stock. If a company is generating cash from its operations, it is more desirable than if it is generating the lion's share of its cash from selling off its investments or its assets, borrowing from banks, or issuing shares of its stock. Although selling property, plant, and equipment, borrowing, or issuing stock are great ways to raise capital for expansion, the company must be able to meet its day-to-day obligations from its operations. Information from the income statement and a comparative balance sheet will be used to prepare the statement of cash flows as well as other general ledger information which will be provided. The operating section. It uses information from the income statement and the current asset and liability section of the balance sheet. So only the current asset and liability section of the balance sheet. That's because current assets and current liabilities are primarily related to operating a business, and current means something that's due within 1 year. Investing section. It uses information from the long-term assets section of the balance sheet. So the only place we will look for information for the investing section will be from the long-term assets section of the balance sheet, and primarily for this class we'll be looking at property, plant, and equipment. Financing section. It uses information from long-term liabilities and the equity section of the balance sheet. So we'll be looking at bank loans, issuing shares of the company's stock, and the payment of dividends. Any non-cash transactions, such as exchanging common stock or a long-term note for property, plant, and equipment, would be disclosed in the footnotes. So there are non-cash transactions that would be recorded in the footnotes as an ancillary information to the statement of cash flows, but it is non-cash because no cash is involved in the exchange. Let's see what a statement of cash flows typically looks like. It would be for a particular company, name the statement of cash flows, and for the period ended. So we have noticed in the income statement, the statement of retained earnings or the statement of owner's equity, as well as for the statement of cash flows, we are looking for the period ended. The balance sheet is the only financial statement that is as of a specific date and time. All the rest of them are like a video. They take a picture or a rolling film of everything that took place during the period, which is typically a month, could be a quarter, and could be a year. What we would have would be cash flows from operating activities, the list of the individual items, and the net cash provided or used by operating activities. This would be one amount. Then we would have cash flows from investing activities, a list of the individual items, net cash provided or used by investing activities, and that would yield a certain amount. Cash flows from financing activities, same thing. Adding these three components together would give us the total net increase or decrease in cash. So that would be the change in cash throughout the year. We would add that to the cash and equivalents, but we're just going to be focusing in on cash of the prior period balance. So at the beginning of the year, we'll add the cash change for the year to the beginning balance of the year, and that should give us cash at the current period balance or at the end of the year. So let's see how this works. So let's look at an example. Both the income statement and a comparative balance sheet are needed to prepare the statement of cash flows. So over here, we have an income statement. We have sales, cost of goods sold, gross profit, wages and other operating expenses, interest expense, depreciation expense, and here are all the income from operations. Additionally, we will have other gains and losses, such as a gain on a retirement of a note, a loss on the sale of a plant asset, income before taxes, income tax expense, and then net income. Over here, this is all in green, and it matches to the green over in this section because this is everything in green is related to the operating section. So this is the current assets, cash, accounts receivable, inventory, and prepaid. So we can see that those are related to operations. Then we can see the current liabilities. Again, accounts payable, interest payable, income taxes payable related to operations. The yellow section represents the investing section. That's the only place that we'll be looking for investing information. Now when it comes to financing, we'll be looking at long-term notes payable, which is the blue section, and equity, which is also the blue section. So I have it color-coded for you guys. So let's look at the first one, the operating section. We are going to be learning the indirect method. Although GAAP requires the direct method to be used, they opened the door and said that you can use the indirect method. And since the indirect method is the most common and the easiest one to use, most companies do use the indirect method. So that's what we'll be learning. So first we'll look at cash flows from operating activities. We are going to add net income because that was income that was earned from operating activities. Next, we want to add any decrease in a current asset. As we go through the individual current assets, I will show you why that makes sense. But here is a mnemonic to help you remember. We're going to add decreases in current assets. We're going to subtract increases in current assets. Now we look at the liabilities, they're going to move in tandem. We're going to add an increase in current liabilities. We're going to subtract a decrease in current liabilities. Next, we're going to add back depreciation expense. That's because depreciation expense is a non-cash item, and we're going to be adding it back because we had net income, which has a deduction for the depreciation expense. So we're trying to move net income back into a cash basis. Then we want to add any loss on the sale of a plant asset. Again, any loss on the sale of a plant asset is the non-cash portion of the sale of a plant asset, and so we're trying to move net income back into a cash, more of cash related, more on a cash basis. And then we're going to subtract a gain. And then we'll add any loss on a debt to retirement and subtract any gain. So here they kind of move in opposite directions. So add a loss, subtract a gain, add a loss, subtract a gain. But this would probably be a good sheet to get a screenshot of and save it to help you study. So let's see how this works. Here we have the information from the income statement, and here we're going to look at preparing the section for the operating section for the statement of cash flow. So the first thing we want to do is add net income. Next thing we want to do is add back depreciation expense. Again, it's non-cash, so we're adding it back to change it net income more into a cash basis. Next, we want to add back a loss. We're trying to get the income statement, net income back to a cash basis, so we're going to add back a loss. And then we will be subtracting a gain, getting it back to a cash basis. Now let's look at, obviously cash is the entire focus, so we'll be looking at that at the end, but let's look at accounts receivable. We can see that accounts receivable increased. It was $40,000, now it is $60,000. This is considered to be a use of cash, and so it will be subtracting cash from operations. Now why is that a use of cash? Because accounts receivable are increasing. We're not getting our money out from our receivables from our customers are not paying, so it is absorbing cash. So it's considered a use of cash. Next, let's look at inventory. Inventory also went up, and it's something we want to decrease. We're saying that it's using cash, and we can see that because cash is being parked here in inventory. We are not turning our inventory over into sales, so it is absorbing cash. Next, we will look at our prepaid expenses. Same here. They're not going down, they're increasing, so it is using or absorbing cash. So we're going to be saying that it is deducting from the net income, the cash basis of things that are adding cash to operations. I didn't mean to say net income there, but the things that are taking away from cash in relationship to operations. Now let's look at current liabilities. Income taxes payable went up, and so that is adding cash back because we're not using cash in order to pay off our income taxes payable. So it's increasing, so it is not using cash, it is adding cash back because we're not paying them these bills. Again, let's look at accounts payable. In this instance, accounts payable went down, so we're using more of our cash to pay down our accounts payable, so it will be considered a use of cash, so it will be a subtraction of cash. Next, our interest payable has gone down, so it's going to be considered using cash to help pay that down, so that will be a deduction of $1,000. So now we're going to look at our net income, all of our components coming from our current assets and our current liabilities, adding back depreciation, adding back the loss, subtracting the gain, and the net cash provided by operating activities will be $20,000. Next, let's look at the investing section, long-term asset of the balance sheet. We are going to be looking at primarily at two things. We'll be looking at cash received from the sale of a plant asset and cash paid for the purchase of a plant asset. This will provide us with net cash provided by the investing activities. Now we have to look and see how plant assets have changed during the year, from the beginning of the year to the end of the year. We can see that there was a $40,000 increase in plant assets, but we can't assume anything because we need to think about this. Was there one purchase that increased plant assets for $40,000, or does the $40,000 represent a purchase and a sale? We will need additional information. And so in each instance, we'll be looking at how to solve for this additional information. Some of it will have to be given to you. Some of it you'll have to use what you know about the financial system and how plant asset purchases and sales take place in order to be able to understand and reconstruct these journal entries. So the company sold an asset as follows. It received $12,000 in cash. It debited accumulated depreciation to wipe this off the books. It credited the plant asset to wipe it off the books because it was we sold it. And we see the cash that we received, the accumulated depreciation in the plant assets, that there was a loss on the plant assets sale. We can see that the net book value of the asset would have been $18,000. We received $12,000, so that meant that our asset, We were carrying it for 18. We received 12, so there was a $6,000 loss. And we remember that plant asset sale loss when we looked at on the income statement. So you would kind of piece this together by a like a mystery solving for a mystery puzzle. You would know that component already. The problem will have to give you either the cost of the plant asset or the accumulated depreciation, as well as the cash you would have received. Next, we can kind of figure out that if we took 30,000 away from plant assets, if our net change was 40,000, then we must have purchased an additional $70,000 worth of assets for the net effect to be 40,000. And we can see from the information that was provided to us in the problem that there was a note payable that they consummated for $60,000 and they paid $10,000 cash down. Therefore, plant assets went up by $70,000 and went down by $30,000, yielding a change of $40,000. This is one example. There'll be many that will be gone over in class and in homework. But this is just to give you an idea of how this is configured. I can't possibly go through every possible scenario, so we'll learn about it in class, but this will show you how the information is pulled together. So we can see we're only looking at the cash portion of these transactions. So the cash received from the sale of the plant asset was $12,000. So focus only on cash and what we're putting together in the statement of cash flows. Next, we can see that we spent cash in the amount of $10,000 in order to purchase the asset, and so then this was the net cash provided by investing activities was $2,000. So we sold one for 12 and purchased another one cash-wise for 10. So we can see the $40,000 change was comprised of the $30,000 that we sold, so it went out of plant assets, and a $70,000 increase, so the net effect was $40,000. So next, let's look at the financing section and the balance sheet. So the cash flows from financing activities will be cash received from issuing stock, cash paid to retire a note, and cash paid for dividends. We need to consider long-term liabilities and equity. The investing section plant purchase indicated notes payable increased by $60,000, but the comparative balance sheet only shows a $26,000 increase, so a note must have been retired. So let's look at this. So there was only a $26,000 increase, so there must have been a retirement of note, and we also know that from looking at the income statement. So you have to kind of be a little bit of a detective and piece together everything you've kind of learned this semester so far in order to figure out how to pull these components together. We'll need additional information from the general ledger. Enough information will be provided to solve for the missing information. Now, as a practical note, if you were doing this actually in a company, you would have this information at hand. The reason why these problems are configured like this for you as a student is to test whether or not you understand how everything is being pulled together and what you learned throughout the semester. So that's the reason for these exercises being configured like this, but typically you would just simply call and find out from the accounting department, or you would be from the accounting department. You'd be working in the accounting department, you would have this information on hand. So let's look at the information from the investing section. The company had purchased an asset, and we saw this in the prior slide. The plant assets increased by $70,000, notes payable went up by $60,000, and cash associated with investing was $10,000. So this does not get recorded here in financing. We're just looking at the fact that notes payable went up by $60,000. So the company must have had to have retired a note as follows, and it must have had a notes payable of $34,000 in order for this to have gone up only by $26,000. So it went up by 60, but then it had to go down by 34 and only for the net gain to be 26. We know we had a retirement gain of 16,000, so if we take the difference between these two, that means that we must have received cash. We must have paid out cash to retire the note of 18,000, which is a pretty sweet deal. We had a notes payable for 34. We were able to contact the contact the person who owned the note and say, if I give you 18, will you take that right now? And so we had a gain of 16 because we were able to pay 18 on a $34,000 note. So we can see the two components of those together, the 60 and the 34, would have given us the $26,000 increase. Now, our next component that we want to look at is we can look at stock issuance. Easily you can see here that stock went up by 15,000. Now this is without a paid-in capital component. So if you were looking at this and we had common stock go up and there was also a paid-in capital amount that went up, you would add those two together to determine how much cash was received from the sale of stock. In this instance, it was only the $15,000 associated with common stock. Then we can look at retained earnings and determine how much cash was paid out to pay out a dividend. Now, if you will look at how to prepare a statement of retained earnings, you will always be able to solve for dividends that were paid out. Remember, the statement of retained earnings would have beginning retained earnings, which you know here because it's on the comparative balance sheet. You would have had net income from the income statement, and so that would have given you beginning retained earnings plus net income, from which you would subtract out any dividends, and that would yield ending retained earnings. So you would have the missing piece of dividends, but by backing into that you would be able to determine the amount of your dividends. So our dividends were $14,000. So let's put this all together. Our $26,000 difference comprised of the note payable being paid down and a note payable being paid down and a note payable being issued, $26,000 increase in net. We can see the cash associated with the amount paid to retire the note was $18,000. The cash received from the issuance of the stock was $15,000. The cash received from, used by paying off dividends was $14,000. And so now we can see all of our components added together. Our net cash provided by operating activities, $20,000. Net cash provided by investing activities, $2,000. And net cash provided by financing activities, $17,000. So we can kind of look at this a little bit, and we see that our operations yielded $20,000, $18,000 of which we used to retire our note, which was a good deal. We paid out some dividends. We issued some stock. Not much going on here in investing activities. So we can see that if we take $20,000 plus $2,000, and that comes $22,000, and then we subtract out $17,000, the net increase for cash for the year was $5,000. Then we start with our prior period balance. So at the beginning of the year, or at the end of last year, it was $12,000. So the change was $5,000. So that means our cash, our ending balance, should be $17,000.